Module 1 of Financial Services deals with financial system. I've given the syllabus, you can go through it if you want. In the first module, we'll be discussing what is a financial system, its definition, what are the components of a financial system, and then we'll look into each component in detail. We'll start now. What is a financial system? In simple terms, we can say that financial system is anything that facilitates free flow of money within the economy. Whatever facilitates circulation of funds in your economy forms part of your financial system. The financial system ensures that fund is always available for productive activities, for productive ventures. People with innovative ideas or people who are interested in developing some sort of a product will always need money or funds. Now these funds, they will borrow from somewhere. So the people who need the funds are known as the borrowers. Those with innovative ideas, you could also borrow funds for consumption purpose, but in our context we are only taking into consideration those funds which are borrowed for productive ventures. So there are borrowers who need funds, and there are also savers who have excess funds in their hand. Savers are people who have set aside money for future consumption. They have some extra money which they can part with. So savers and borrowers are brought together, or the gap between the savers and borrowers are bridged through financial system. Those who need funds and those who have funds are brought together. Now, how is this made possible in the financial system or through the financial system? The financial system consists of various financial assets which ensure that there is proper transfer of funds. Through financial assets, we can transfer funds from the savers to the borrowers. Financial assets can be used to attract money from the savers and then help the borrowers to raise the funds that they need. Now, there are financial assets like shares, debentures, bank deposits, provident funds, insurance policies. There are different types of financial assets, and it all forms part of your financial system. Now, in order to buy or sell these assets, there needs to be a place, and we'll say that this place is called a financial market. Financial market can be in physical form or virtual form. It need not be an actual place. So there is a place for dealing in financial assets. That financial market would also form part of your financial system. Now, once there is a market and assets, we need intermediaries. We need people who will bring together these buyers and sellers, or the savers and borrowers. So these intermediaries could be banks, financial institutions, the Reserve Bank of India. So they are all individual money lenders. So there are different people who play an active role in making sure that the financial system functions properly. So these people are known as the financial intermediaries. And there are various financial services being offered. So this will also form part of your financial system. All these ensures that there is proper circulation of funds, that money is channelized from the savers to productive ventures, and it also ensures that there is money transfer within the economy. So in simple words, we can say a financial system is a network of financial institutions, financial markets, financial instruments or assets, and financial services that facilitate money transfer. I've also given a definition by Amit Chaudhry. According to Amit Chaudhry, financial system is the integrated form of financial institutions, financial markets, financial securities, and financial services which aim to circulate the funds in an economy for economic growth. So the two main points that you need to keep in mind when you hear the term financial system is that first, it ensures that there is proper circulation of funds in the economy, and second, it mobilizes the savings and channelizes them into productive activity, and thereby influence the pace of economic development within the country. So a financial system is that system which ensures that there is proper supply of funds for productive ventures. Now, what are the functions of a financial system? The first one is provision of liquidity. Liquidity means money which is readily available. It could be in the form of cash or near money assets or near cash assets. That is, those assets which can easily or quickly be converted into cash. Now, in this economy, we need funds which can be raised for productive ventures. So, liquidity need to be ensured. But while we are ensuring that there is sufficient supply of money in the economy, we should make sure that there is no undersupply or oversupply of money. It will lead to other problems. So the country has Reserve Bank of India as the regulatory authority, and it ensures that there is always sufficient funds for productive ventures. Now the Reserve Bank of India is the one who issues currency notes and coins, and there are other financial institutions which also take part in the process of credit making. That is, they will accept deposits from the public and lend out money. So they are also engaging in flow of funds within the economy. So provision of liquidity is made possible through financial system. That is, if you need money for productive ventures, you could just approach a financial institution and get money as loan, or you could issue some financial assets in the financial market and raise funds from there. And there are various avenues. So it ensures there's provision of liquidity. Now there might be a person who has already bought a financial asset. They might be in need of money. They could just go to the financial market, sell that security and convert it into cash. So there is a proper system in the country to ensure that there is financial liquidity. Second one is mobilization of savings. There are a lot of savers, people who have set aside money for future consumption. If they keep that money in their hands, it will remain idle. It is of no use to anyone. So they will definitely be interested in parting with their savings for a short period of time and to make some extra money out of it. They might be interested in depositing it in the bank, or they might be interested in depositing it in a stock exchange, or they might want to purchase an insurance policy to give them protection against risk. And there are various avenues open to a saver. These avenues are there because of the financial system. So it helps in mobilization of savings. If we do not have various options for investment, then people will not part with their money. Because there are various avenues available to them, they will part with their savings. These savings are collected by banks, by mutual fund agencies, by insurance companies. They will all mobilize these savings and then use these savings for productive purposes by lending it to companies and corporates. So the first one is provision of liquidity to ensure that there is proper supply or proper funds available in the economy. Second one is mobilization of savings. The funds remaining idle are all collected and then it is given to those who need the funds. Third one is size transformation. See, all of us have got different levels of income, and the money that we save will also differ. Some people might have only a small amount as savings, while some will have a huge amount of savings. So whatever the size of savings, it doesn't matter. We just need to collect it from the savers. What they're saying is that in a business, they will need huge funds as money. They need huge funds for investment. So a single saver cannot contribute all these funds the funds that are required. So we'll collect it from various small savers, pool this together, make it into a large sum and then give it to a person who needs it. That is what they're saying, size transformation. If you're collecting the money from one person, it is not possible to cover the requirement of the person who needs the fund. So you'll collect it from different savers, pool together and then give it to the person who needs it. So that is size transformation. Small savings will all be put together to create a huge amount and then it will be given to the person who needs it. That is why we say there is size transformation. Fourth one is maturity transformation. Some people might be interested only to invest it for a short period of time. At the same time, from the part of the company, from the point of view of the company, they will need the funds only for a short period of time. And there could also be circumstances where the funds are required for a very long period of time, and there are investors who are willing to part with their funds for a long period of time. So whatever is your maturity requirement, whatever is the maturity requirement of the lender and the borrower will be taken into consideration, and their needs will be met through the financial system. Last one is risk transformation. An individual saver will always have an apprehension. He will hesitate before making an investment because he does not have a proper idea about the market or the financial market and the financial assets. So what we can do is we can approach intermediaries who are experts, who have got up-to-date information about the current financial situation. So the funds that individuals have can be handed over to these experts, who will then assist them to channelize it or to invest it in better options, better financial assets. So we can approach a mutual fund who will pool together the funds of different savers, and they will choose the most profitable venture in which you can invest and thereby assist you. This helps in risk transformation. If you're an investor who has got only a little knowledge about the financial condition, then it is best to hand your money over to an expert who will reduce the risk and then make sure that you get a proper return for your money. So these are the functions of your financial system. Now these functions, I have reframed it into different points. The first one is it provides that it ensures that there is a payment system for exchange of goods and services. Helps in pooling together funds. Pooling of funds means you are bringing together the small savings of different savers and making it into a huge money that is then transferred to the person who needs it. So pooling of funds for undertaking large scale enterprises is ensured. Then the financial system provides a mechanism for effective transfer of resources. You can transfer these resources through various assets. There is a saver, there is a borrower, and these funds can be transferred through a financial asset. That is, if you are a company, you could issue a share and the saver will purchase this share. So the money which was saved by the saver gets transferred to the company through the share. So there is a mechanism for effective transfer of resources that provides a way of managing uncertainty and controlling risk. The last one, that is, I said if you are a new person, a new investor or a single investor, you could just hand over your money to experts, because the financial system will ensure that these intermediaries will utilize your funds in a proper way and give you sufficient returns. Now that generates information that helps in coordinating decentralized decision making. If you study the movement of the stocks or the take into consideration the financial condition of the country, it will help you to make proper financial decisions. So these are the functions of the financial system. What are the components of financial system? It consists of 4 components: the financial market, financial assets or financial instruments, financial intermediaries of financial institutions, and financial services. Keep in mind that financial assets is also known as financial instruments, and financial intermediaries are also known as financial institutions. Now the question might be, what are the components of financial system, or what is the structure of financial system, or give the organization of the financial system. Whatever is the question, we have got the same answer. There are 4 components, and these are financial markets, financial assets, financial intermediaries, and financial services. These are different components of a financial system. So we'll stop there. We'll discuss each component in detail in the next session.